All right, everybody. Looks like we missed a little bit of the intro there, our disclaimer, but I am hoping you can all see me right now. Can everybody see and hear me? Good Wednesday afternoon, everybody. How are we doing? Really hoping we are coming through. There we go. All right. Thank you, everybody. Thank you. So as I just mentioned in one of the trading rooms, we've seen about a 25, 30 point sell-off over the last several minutes here. S&Ps are still positive. They're up about 10 points right now. This absolutely all has to do with Trump's announcement on the tariffs for the EU. He said that EU tariffs are going to be 25% on autos and other things starting April 2nd. We'll see if that is actually priced into the market or not. The initial reaction is obviously the market doesn't like that, but listen, this market is so dynamic and so fluid. We can see anything happening here, guys. So, hello, everybody, and welcome to Wednesday. Welcome to Wednesday. Pat, you like this? I probably got to shave, huh? I don't know. My wife says she kind of likes it. So she is the boss. She is definitely the boss. Got a question. I see right now there's an announcement. This is totally not related to trading here. I just got some breaking news here that the Slack app and website are down worldwide. Any of you that use Slack see that right now? I don't think we're having any issues here, and we use it. But I'm just curious if any of you that use it have that or seeing that or not. Okay, so what are we talking about today? Besides having to be very, very reactive and proactive to the market. All strategies don't work in all situations. We need to know when is the right time to use certain strategies. So we're going to talk about option volatility trading. Yeah, John, it's a little too warm here. It is getting too warm. Even with all the snow that we got last week, it's starting to get a little slushy here. We definitely need a refresh. But the bluebird skies are certainly very, very nice. So what are we talking about today? And again, I'm just going to keep an eye on the market really closely here because if we start to break down here ahead of NVIDIA earnings here, boy, that's going to put even more pressure on NVIDIA. We'll talk about that too. Option volatility trading. How do we know what strategy we are going to use? Howard, thank you for letting us know about Slack. I appreciate it. How do we know? Okay, let's say we're bullish. How do we know if we should buy a call spread or sell a put spread? If we're bearish, how do we know if we should buy a put spread or sell a call spread? And I'm going to keep this conversation today pretty much just tied to the basic strategies. Okay. Don't want to really go into anything exotic. Okay. But what do you all think that this is based on? What do you think the type of strategy is based on? Once you've determined your direction, bullish or bearish, how do you then know what to do, right? Because there are literally an endless amount of strategies. Yeah, Gene and Bear, love it. Love it. I don't mind if anybody else joins in here. Gilbert, love that. Love that. Love that. Love. Nope, Stephen, we always have to measure risk. There's no question about it. But what risk do we take? Well, that's really going to be based on where is the implied volatility. Where is the, and I got to get my drawing tool here. Where is the implied volatility at any one time? Okay, so how do we know if we're bullish? Let's buy that call spread. We think stock is going to go up, or let's sell that put spread, right? It all comes down to extrinsic value. It all comes down to the premium priced into an option, which that is implied volatility. So some of you may have seen this in the past. Okay, this is actually in our documents folder in the room. This is a matrix that we created here. It's kind of just a basic step-by-step fit the puzzle pieces together guideline. Okay, again, this is really only kind of showing here the basic strategies. Endless amount of possibilities to get to the position you want to get to. But let's review this, okay? Let's review this column by column. And we will start in the bullish column here. So let's say you think a stock is going up. Let's see if I can get my drawing tool to actually work here. No, it sure doesn't seem like it. That's not good. Not sure why. Have to figure that out here. But let's say you are bullish, okay? Sure, buy a call spread. Buy a call spread. It's going to cost you money to do that, right? It's going to cost you money, so it's a debit. And the best time to do that is when volatility is low. Why is that? Why is that? Anybody? Okay. Premiums are lower. Exactly. Premiums are lower. It's going to cost us less. Now, also, think about what happens when volatility is lower. What does that do to the expected move? What does that do to the expected move? When vol is lower. And man, I got to really get my drawing tool going here, guys. Hang on 1 second with me. I know it just went all wacky on the screen here for a moment. But when vol is lower, what does that do to our expected move? Come on. Come on, computer. There we go. Okay. Yeah, it makes it smaller. It makes it tightened up. Okay. So if we're buying a call spread then, and we're targeting the short strike, which we always want to do, if vol is lower, the expected move is lower, that means the target that we need to hit is not as far away. Does that make sense? So not only are the premiums lower, but the target for where we need to hit is lower as well. Okay, now, Danny, thank you. You say there is a drawing tool on the top left corner of the PDF. Oh, I guess there is. Let's see. Oh, Danny, lifesaver. Thank you. Okay, now, what happens if vol is really high? Okay, we're bullish and vol is really high. Just kind of take that thinking we just went through and flip-flop it. Okay, in that instance, we would rather sell a put spread. right? We would rather sell a put spread. Why? Well, number one, the premiums would be higher, meaning if we sell a put spread, we're getting a credit. We're putting money in our account. We're putting in more money than normal when those premium levels are higher. Now, think of it in terms of the expected move. Just like we talked about when vol is really low, it contracts that expected move. So our target is not as far away. When vol expands and it's really expensive, the expected move also expands and gets wider, makes it further away, more difficult to get to the trouble spot that we might be selling. Does that make sense? Yeah, theta works for you. Theta works for you. Awesome. Okay, now, what about other types of strategies than just call spread, put spread? Okay, well, two reasons why we would buy. Okay, again, when I say buying something, that means we're spending money. That means it's a debit. We're laying money out. Obviously, we want to pay as little as possible for any spread that we're doing. Okay, when volatility is really low, calendar spreads, time spreads, or diagonal spreads are fantastic. Why is that? Because we're buying time with our long option and we're buying volatility with our long option. And when implied volatility starts to revert back to its mean, to its average, which option is going to get affected more? The one that we have bought that's further out in time. Okay. Now, before I move on here, Danny, how many likes do we have smashed? How many likes do we have smashed? Danny, what's our number, man? I know Danny's filling in for Mike today. You guys always hear me talking to Mike. Thank you, Robert. Today it's Danny. And Danny must be doing something else, so I'm going to move on here. Danny, Danny, Danny. Let's all say Danny. Unfortunately, that's not the word of the day. All right. All right. Robert, you say 33. All right, I can move on right now, but we're going to do a little bit. Actually, we're going to go to the word of the day first, and then I'm not going to go on any further until we have 40. So today's word of the day, it's actually an acronym of the day, stock symbol of the day today. It's what everybody, the entire world is going to be looking at in about 4 hours. NVIDIA is, or NVDA is our word of the day. Okay, put that out there. Smash the like while you're doing that. Smash the like while you're doing that. All right, thank you, everybody. Let's look now at, instead of going to the neutral column here, let's go to the bearish column. Okay, if we think a stock is going down, we're going to use the same thought process as we did in the bullish column, but we're going to use puts on the buy side, calls on the sell side. So when volatility is really low, again, we'd rather buy something. We'd rather pay less than normal. So we're going to just buy a put spread. Ah, Paul, boom, love it. Love it. Tell him to join in here, Paul. Maybe they'll have a chance to win one. Tell them to join in. So vol is really low. Buy a put spread. Cheaper premiums. And because that expected move has contracted, make it easier to reach our target. When vol is really expensive, guys, and you're bearish, sell a call spread. One of the things I looked at today, and I know I put out a signal today in BABA, a bearish signal. I was toying with selling a call spread instead of buying that butterfly because vol was more expensive than normal. Okay, same thing. If vol is really low, another fantastic strategy if you're bearish is to buy a calendar, buy a diagonal using puts. Using puts. Okay, now, how does a butterfly or a broken wing butterfly factor into this? Okay, the beauty about using a butterfly or a broken wing, that's easy for me to say, broken wing butterfly, whether you are bearish or bullish, is that a butterfly typically is very neutral implied volatility or very neutral vega. Okay, so you're not really looking for vol to go up. You're not really looking for it to go down. It's a type of position that you can take a directional position and not be concerned so much about what happens to volatility. So if you are kind of, a little bit confused, or maybe vol is right in the middle of the channel and, it's where it should be and it's 50-50 chance it could go up or down, a butterfly or a broken wing put or call butterfly is a great way to take a delta position, a directional position, and not have to worry about a change in volatility. So that is why this morning in Alibaba, that is the signal we put out. It was a put butterfly rather than selling a call spread. Okay. And it always comes down to reward to risk, right? What is my reward to risk? We've gone through that before. We have our cheat sheet. We'll do that again another time here, but it all comes down to reward to risk. S&Ps are still leaking a little bit. They're getting towards the flat line here. Not so sure the market likes the announcement on the tariffs here, but we'll see if that recovers at all. Okay, does that make sense on the butterfly, everybody? Does that make sense on the butterfly? And in fact, what I'm going to do is put up a live example here of the BABA butterfly. And I will show you that it is very neutral volatility or vega. So let me pull this into our screen here. That's probably a little big. Okay, this is the position that we were trying to buy this morning. Okay, buying the 135 put, selling 2 of the 127 puts, and buying the 125 put. Okay, it's bearish. Why? Because, well, we can see negative delta, right? Negative 14 delta. Now, how do you see on your platform what the vol, what the vega is to that? How much volatility risk do we have to that? Well, on my platform, I'm going to use this. Oh, where did that go? Hang on, I got so many windows open here. Hang with me here, everybody. And there it is. Okay, so on this particular window of my risk analysis, okay, we can see numerous, well, you can't see anything right now because I just messed it up again. Okay, here it is right here. Oh, every time I switch that over, so let me not switch that over. If you look over here at Vega, okay, the Vega number is very, very minimal. In fact, the Vega number goes down to the downside, negative. That's a good thing. Okay, so the Vega number is very, very minimal. So in general, butterflies, broken wing butterflies, don't really get affected by a change in implied volatility. Okay, now there are obviously other strategies to get your deltas, whether you want to be bullish or bearish, long or short. There are definitely other strategies. Not going to take the time to really go into those right now, but Iron Condor is typically a neutral strategy, but you can skew the strikes in an Iron Condor to achieve a delta bias, whether that delta bias is long or short. Now, let's talk about if you're neutral, okay? If you're neutral, you think a stock is just going to remain in a tight range or some sort of range, selling an Iron Condor is phenomenal when the vol is high. Okay? Selling an Iron Condor is just a combination of selling a call spread and selling a put spread. Look for the stock to consolidate, stay in the middle. When do we want to do that? When could we get the highest price for that? When vol is expensive. Okay? We could also sell an Iron Butterfly. Okay? Does everybody know what an Iron Butterfly is as opposed to a regular butterfly? What's the difference between iron and not iron? Okay, give a quick little lesson on that right now. Real easy to delineate between the two. Okay, when we were talking about butterflies earlier, there you go, Clive, nicely done. When we were talking about butterflies earlier, we were talking about either a call butterfly or a put butterfly. So all of the options are on the same side of the ledger, right? Either all calls or all puts. An Iron Butterfly, like Clive just said, is when you have a call and a put. So let's look at an example here. I'm going to bring my Baba back in here. Okay, this is what we tried to do in Alibaba earlier today. Okay, everybody sees that, right? We tried to buy this broken wing put butterfly. Everybody sees it? All the options are on one side of the ledger. All right, man, where did my drawing tool go again? Ooh, I'm having some issues today. There we go. Okay, all of the options are puts. Now, if we wanted to use the exact same strikes, but turn this into an Iron Butterfly, okay, right now we're long a 135 put, short 2 of the 127 puts, and long a 125 put. Well, what if we were still long a 135 put, short only one 127 put, but then short a 127 call and long a 125 call? This position would be the same as this position. The reason we don't use them is because typically the pricing is going to be about the same. But when you start mixing the combination of calls and puts in a trade, it confuses people. But an iron butterfly typically will give you just about the exact same reward to risk and P&L as a regular butterfly. Okay, and then if we are neutral, we bring this guy back in here. If we are neutral, strangle swap. What's a strangle swap? It's the combination of a calendar call spread and a calendar put spread. Okay, now, those of you that maybe are a little bit more advanced, you can take this matrix, this debit credit matrix that we have created, and you can go with the concepts that we have on here, the strategies that we have on here, extrapolate them out, okay, and come up with your own creation. That's the beauty of options. There are an infinite amount of ways to get to the same end game, whether it's directional, whether it's volatility, theta, whatever it might be. There are an infinite amount of ways. But so many people get caught up because they don't know really about implied volatility and extrinsic value and premium. So many people will get caught up just buying calls or buying a call spread if they're looking for a bullish position, not understanding implied volatility and realizing that, man, oh man, when that vol normalizes, you can get whacked on that. Even if you're right directionally, you can get whacked on that volatility. Same on the put side, which is why, to me, the holy grail of a position, to me, what I always strive for is to come up with a position that I want directionally, bearish, bullish, neutral, combined with a positive, a negative, or a neutral Vega position based on the charts of where implied volatility is. All right, guys, last chance here. Last chance. Going to give you 30 more seconds here to get your names in for the wheel. Okay, and also I'm not going to spin that wheel until we get at least 50 likes. Ooh, Richard, tire doctor in under the bell here. Nice, Alonzo. Anybody else? You got your last chance here. All right, we got the likes. We got 52 likes. I appreciate that very much. 53 now. As a quick side, while I'm waiting for the wheel, how many of you joined us yesterday in our coaches roundtable? And S&Ps are just about to go negative. Thank you, tariffs. What'd you guys think of the coaches roundtable? Oh, someone's back home here. Wheel is closed. Yes, there is a recording. I'll actually post that up here, guys. Hang on one sec. Let me post the recording up here. Hang with me. I know it is here somewhere. Somewhere. You guys don't want to hear me sing. Let me get my link. There it is. Here is the recording, everyone. That is to yesterday's coaches roundtable. All right. And the wheel is all set. Let's get to it. Here we go, guys. Thank you, Cheyenne. Appreciate that. Robert, thank you. Thank you. All right, guys. As I think it was Paul mentioned earlier here, the new swag, the new Mark and Mine swag is out. People are loving it. Spoos are negative. And the wheels in motion. Today's winner, who do we have? Is it going to be Drew, Bill, Robert, Andre, Alonzo? Who is it, Andre? You are the winner. Andre, are you here? Andre, are you here? If you are, I just posted up the email that you need to send me your name, size, and mailing address to. But you got to be here. You got to be in it to win it. Oh, you just made it, Andre. Nicely done. Nicely done. All right, make sure you send me that info, please. Appreciate everybody being here, guys, and we will see you again tomorrow. Watch out for NVIDIA earnings right after the bell today. Have a good one, everybody.